The stock market roared back 6% in May, erasing the tariff crash like it never happened. But underneath the surface, inflation fears and a slowing economy are coiling up like a spring, ready to snap. Hey Bowtie Nation, Joseph Hogue with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, with that threat to tariff inflation and the economy, it's more important than ever to be picky about the stocks you buy. That's why I'm digging deep into the data for the stocks I'm buying in June, and I found 5 stocks you need to see. 4 AI giants still trading at fire sale prices, and 1 beaten down name that could jump 40% if Congress steps in. I'll highlight the 5 stocks I'm buying now, along with updates to CrowdStrike and Broadcom, and what happens with the tariffs now that the courts have stepped in. On to that main topic though, and even with Friday's craziness, the market has shot up 20% since the April 8th bottom, but I'm still worried it's gone a little too far, too fast. We'll start seeing more tariff effects on the economy through inflation this month, and I'm getting more cautious on what I buy. That means digging into the value plays, but not your traditional value stocks. We have to sacrifice growth for a good deal. Hell, the price to earnings ratio on shares of Stellantis, ticker STLA, looked great at 4.9 times until you realize that sales are going nowhere, expected down 1% this year and up just 4.8% next. No, I'm looking for value plays, good deals in fast-growing companies. I think it's a mistake a lot of investors make, thinking you can only have one and not the other, growth or value, but not both. After all, what good is having your cake if you can't eat it too? So I started digging into the growth stocks I watched, those in my favorite themes like AI, cybersecurity, and software. I looked for price valuations on a price-to-sales basis, then adjusted these for growth to find the best deals. I'm putting that research together for a full video, ranking all 60 AI-related stocks for the best value, so make sure you're subbed to the channel and have notifications turned on so you don't miss that one next week. But I'm using that initial research for the stocks I'm buying right now. And the first stock I'm buying is Hewlett Packard Enterprise, ticker HPE, down 19% this year on weak demand in PC and laptop sales, but with a strong upside in the data center server market. Now, HPE is reporting earnings Tuesday after Dell reported positive guidance on its data center numbers, and the big reveal here is that Nvidia's numbers reported last week. The AI chip leader didn't blow away the market like it usually does, but it still confirmed that AI and the data center theme still has a lot of momentum. Nvidia revenue is still forecast up 53% this year, with Blackwell in full production mode and shipping 13,000 chips in the first quarter alone. Well then, where do you think all those chips go? You have to put those semiconductors, those GPUs, together into a server, and thousands of servers in a data center means sales growth is going to continue to skyrocket for server makers like HPE, Dell, and SMCI. Now, HPE revenue is only forecast up 8% this year to $32.5 billion because that laptop and the PC environment is holding it back. But that's cyclical and is going to rebound within the next year or two. That's going to recharge growth, and the shares are extremely cheap here, trading for just 0.75 times on a price-to-sales basis, which is a 16% discount to the average ratio over the last year. Next up, I told myself I wouldn't do it, but I ended up adding to my position on Super Microcomputer, ticker SMCI, last week after that Nvidia news. Now, this was already my largest position by far, with 24,000 shares worth nearly $1 million and approaching 14% of my total wealth. Now, you out there in the nation know I try to keep any one stock at less than 10% of my portfolio to keep that stock-specific risk low, but this one is just too good to pass up. And I added another 700 shares in my main account and 3,000 shares in another account. And that's because while the Nvidia news was good for other data center server makers like HPE, Supermicro is the AI server king. In fact, the company controls more than a third of the high compute server market. One Raymond James analyst recently called SMCI a near pure play in AI. SMCI revenue is expected up 47% this year to $22 billion and to almost $30 billion next year. If that AI data center building keeps up, these numbers could go even higher, but if you look at this valuation, there is a huge disconnect. At a market cap of $23 billion, shares trade for just 1.1 times its last 12-month sales, and for just 0.8 times next year's expected sales. In my research of those 60 AI stocks I'm going to show you in next week's video, there is no other stock that even comes close to that kind of growth trading so cheaply. These shares should be double their current value or more over the next year. Now, because SMCI is still volatile as hell, I'm taking advantage of those options premiums to sell covered calls against some of that position. For example, I can sell the call options expiring in June of next year, so about 1 year out, at the $50 strike price for over $10 a share. That is a 25% cash return on the stock, lowering the net cost to $30 a share. And if SMCI does pass $50 each by that expiration, I make 66% return in 1 year. Also in the AI theme, I'm buying shares of DigitalOcean, ticker DOCN, down 17% this year, but with solid growth and value. DigitalOcean provides a full-stack cloud platform used by hyperscalers and AI that is simple and scalable. Revenue growth isn't great here, but it is good at 13%, and importantly, it's consistent with upside to higher growth. And trading at just 3.4 times on a price-to-sales basis for that kind of growth is very attractive, and in fact, a 27% discount to the one-year average valuation multiple. Here, I'm also adding to my position in UiPath, ticker PATH, initially up more than 15% on its blowout earnings last week, but giving back most of it by the end of the day on Friday. Now, I like Path on its AI platform for process automation, a $30 billion market, and while growth has been underwhelming at just under 10%, the fact that earnings could send the stock up 15% initially tells me the company is moving in the right direction. Next here, not in that AI theme, but with a big upside, I'm buying shares of solar leader Sunrun, ticker RUN, after its 42% crash in shares last month. The solar stocks just got slammed when the House of Representatives passed its budget proposal repealing the clean energy tax credits, a disastrous scenario for the industry, according to one analyst. But we all know the market always overreacts to stuff like this, like an 8-year-old on a bad day. Several senators are already vocally lining up to save or at worst phase out those credits to avoid the worst of the provision that, according to Sunrun CEO, would cost 250,000 jobs and increase household electricity costs across the country. Now, the Senate has targeted a July 4th deadline for its changes, so we could see some good news on the stock by then, and this is much more a trade than a long-term investment. Instead of buying the shares, I've set up a bull call spread, buying the $6 call options for $1.73 while selling the $10 calls for 41 cents and a net cost of $1.32 each. Those options expire mid-July, and if the stock makes a run for that $10 or $4 value on that spread, I'll make a 203% return in just over a month. Even if they don't shoot higher, there's a lot of support here, right around the $7 a share. My cost basis only needs the stock at $7.32 each to come out even. Now, if you want to see how I set up that options trade or the other 28 option strategies I use for returns like that 203% potential, check out the coupon code linked in the description for $150 off our Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through 29 option strategies, when to use each, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly what to expect. I'm relaunching the course at a 38% discount, so check it out risk-free with a 14-day money-back guarantee with that link. Now, looking at the stocks I'm watching this week, Dollar General, ticker DG, reports its earnings on Tuesday and is followed by Dollar Tree, ticker DLTR, on Wednesday. But the names in these two stocks is where the similarities end. While both compete in that discount category of discretionary retail, Dollar General likely has a better upside going into its earnings. The problem for Dollar Tree is twofold here, that mix in sales and imports. Dollar General books a greater percentage of its sales from food and consumables, fewer of which are imported. In fact, the company says only about 10% of its sales are impacted by tariffs. Dollar Tree, on the other hand, imports as much as 43% of its products, with China accounting for the majority of that. Both stocks have jumped this year, erasing that tariff sell-off, with DLTR up 21% and Dollar General up 29%. But even on that outperformance, Dollar General is by far the better stock. DG is still expected to post positive sales and earnings growth this year, with revenue up 4%, though at the near-term quarters are going to see some earnings weakness. For its part, Dollar Tree is expected to see revenue plunge by 40% this year and post a 5% decline in its earnings. Now, against this, shares of Dollar General are less expensive as well, trading at a price of 0.53 times sales, 19 times earnings, while Dollar Tree trades for 1.1 times sales and just under 19 times on that price-to-earnings basis. Now, retailers have surprised lately, some ignoring the tariffs and some just not providing outlooks, but among these two, it's hard not to see Dollar General as the better buy here ahead of those earnings this week. Also watching CrowdStrike Holdings, ticker CRWD, is going to be reporting its earnings on Tuesday, with the stock up 110% since last year's July outage mess. You out there in the nation know cybersecurity is my favorite long-term growth theme, and CrowdStrike's Falcon platform is the best in the industry. But shares have gotten a little expensive lately. The company is expected to post sales growth of 20% this year and next, though competition is driving costs higher and profitability lower, with earnings per share seen 12% lower this year before rebounding. As Zscaler, another of my cybersecurity holdings, surprised higher in its earnings last week, sending the stock up 8% on Friday. And while CrowdStrike is my largest cyber position, I'm not buying ahead of its earnings. Shares are priced very higher at 28 times sales, so waiting for any sell-offs before I add to that position. Broadcom, ticker AVGO, is also going to be reporting its earnings on Thursday, expected to post 20% sales growth for the quarter and a 42% jump in earnings. The full-year numbers are expected just as good, with 20% revenue growth and earnings to $6.64 a share. Now, Nvidia's earnings report that showed the AI data center build-out is still firmly on track is great news for Broadcom, with AVGO products throughout the AI infrastructure. Because of that, this is my second favorite play on the theme after that super microcomputer, ticker SMCI, but shares are not cheap here. The stock trades for 21 times on a price-to-sales basis, well above the 17 times valuation it's traded at over the past year. And there is still potential for an earnings upside to the price if management can raise that outlook, but hoping for a better price on this one as well. Showing you the bigger picture here with the Sector Spider sector tracker. 10 of the 11 stock sectors closed higher last week, with energy stocks the lone laggards. That takes the loss for the sector to 4.8% for this year and 10% over the last 12 months, but could be setting up energy stocks for a great opportunity. While stocks in the sector posted a 12% decline in earnings for the first quarter, and are expected to post an even bigger decline of 25% when second quarter earnings are reported starting in July. Profits of energy companies are forecast to rebound 21% next year for the best performance of all 11 sectors. The stocks in the sector are also the cheapest in the market, trading for just 14.6 times expected earnings over the next year. Not only is it the cheapest PE ratio among the 11 stock sectors, but also the only sector trading below its 10-year average valuation. Now, energy stocks are likely to continue to struggle over the next few months, but long-term investors will be rewarded by beginning to pick up shares over the rest of the year. Favorites continue to be Chevron, ticker CVX, Diamondback Energy, FANG, and Devon Energy, ticker DVN. Looking at a longer-term trend here, consumer discretionary stocks, companies in those apparel, travel, restaurants, and auto industries are separating the winners from the losers through those Q1 earnings. The tariffs have been a crucible moment for the sector, and just 17 of the 51 stocks in that discretionary group are higher over the last 3 months. Looking at the leaders here gives you a sense of which might have a competitive advantage or just better management, like Ulta Beauty, Ford Motor, DoorDash, and McDonald's, while the biggest laggards, like Best Buy, Nike, and Lululemon, should be avoided. Updating our market outlook, the United States Court of International Trade shocked the market last week when it ruled President Trump could not use a 1977 law to impose blanket tariffs. The fact that stocks barely budged on the news, though, should give you a hint that tariff pain is far from over. In fact, the government got a quick stay of that court order from the appeals court, keeping tariffs in place for now. And the president's authority is likely going to be settled by the Supreme Court after the appeals court process, but there are a few reasons here why that last week's news is a negative for stocks. First is Trump has several other legal ways to reimpose those tariffs, even if the use of the IEEPA is struck down. More importantly, though, the court ruling takes away some of that urgency other countries have for negotiating tariff deals. After all, why give in to any of the U.S. demands if tariffs might be struck down anyway? That appeals process is likely to drag on through the July 9th expiration of the 90-day pause period. My hunch is that Trump is going to extend that pause because of the court's intervention, but we're less likely to get any more big deal announcements. And we'll also start seeing some of those tariff price increases through inflation data this month, first with the Consumer Price Index that CPI reported on the 12th, and then the PCE report at the end of the month. If inflation does pop, as it's expected to do, that's going to put a gloom over investor sentiment and weigh on stocks. We could also see those tariff effects coming through in the monthly jobs report this Friday. Expectations are for just 125,000 jobs created last month versus 177,000 in the month before. Now, if that estimate is right, it would continue the slowdown we've seen for the last year. Growth averaging 175,000 new jobs a month over the last 2 years has slowed to just 115,000 jobs in 2025, and tariffs threaten to push that even lower. It's not signaling a recession just yet, but employment has a nasty habit of turning lower very fast, so be watching this one very closely. Get your $150 discount with the coupon code in the description below and learn how to use options to boost your returns and create income. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.